Too much money, too fast, with no effective oversight on how to spend it. In the last few years, this seems to be the norm. The financial landscape is changing, and after years of wild investments in unsustainable business models, the fundamentals of blitzscaling methodology is put into doubt by the finance world. This is definitely not the new normal. The debate is more polarized between people believing the current startup model is failing miserably and people who defend it no matter what. Today, we're going to talk about metrics for sustainable and fast business growth, without losing sight of concepts such as profitability and cash flow. Hey everybody, I'm John. I'm the Finance and Strategy Officer at Growth Tribe. Current abundance on cheap financing and over-reliance on it is not sustainable. Therefore, growing businesses have to be prepared to improve their financial health, face economic downturns, compete with other growing companies to attract capital and finance their growth phase. In this video, we're going to have a look at which financial indicators are the most relevant throughout these steps of business growth, and why financial management with a focus on cash flows, profitability, and indebtedness are key factors for a company to sustain its growth and well-being of its shareholders, employees, clients, suppliers, and also the surrounding community. In other words, how fast can a company afford to grow? And how do you identify the proper balance between consuming cash and generating it? Let's start by taking a look at general stages of business growth. Across the years, different mindsets have inspired entrepreneurs on where to concentrate efforts to grow a business. Good examples are the Lean movement and blitzscaling, but they all relate back to the 5 stages of small business growth framework, published in Harvard Business Review in 1983. For example, once a company has validated the proposed existence by getting enough customers and becoming a viable business, it is time to go beyond product market fit and the simple relationship between revenues and expenses. We would not only measure the past and the current ratios, but also aim to get an accurate picture into the future through forecasting. Let's take operating cash flow ratio for example. This is simply how well the short-term liabilities are covered by the cash flows generated from a company's operations. Let's break it down. Cash flow from operations is the cash equivalent of net income. It is the cash flow after operating expenses have been deducted and before new investments or financing activities. Current liabilities are all liabilities due within one fiscal year or operating cycle. Hence, the operating cash flow ratio is a measure of the number of times the company can pay off the current debt with the cash generated from the same period. A high number, greater than 1, indicates a company has generated more cash to pay off its current liabilities in a given period. Then, during the next stage, the survival, a company has to ask itself, can we continuously generate enough cash to break even? Can we generate enough cash flow to scale up to a size that is sufficiently large given our industry? If the answer to both of these questions is yes, and the owners have a desire to move forward, then we enter into the success phase. And here, things start to get a bit more complicated. If the owners wish to keep expanding at a fast pace, instead of just solidifying the existing business and profitability, then they use the company as a platform for growth. Here's when companies might adopt some sort of aggressive growth program that might emphasize speed over efficiency. In the blitzscaling book, for example, some cited practices which are still prevalent are: ignore the customer, provide whatever customer service you can as long as it doesn't slow you down, tolerate bad management, implement a financial strategy that supports aggressive spending. Even though these sound irrational and the perfect recipe for failure, these practices in the last 10 years have been possible due to the ability of businesses to raise money in rounds of funding from debtors, venture capitalists, and private equity investors. As highlighted by Ray Dalio, co-chairman of Bridgewater Associates, investors lending to those who are creditworthy will accept very low or negative interest rates and won't require having their principal paid back for the foreseeable future. They are doing this because they have an enormous amount of money to invest that has been pushed on them by central banks that are buying financial assets in their attempts to push economic activity and inflation up. These investment managers have large piles of committed and uninvested cash that they need to invest in order to meet their promises to their clients and collect their fees. The typical and recent example is WeWork, a space leasing company, a case of unrealistic valuation and bad managerial practices that you probably have heard about. During the 12 months leading to March 2019, the company was losing more than $200,000 every hour. Okay, back to the 5 stages. In the success growth substage, the company then allocates resources for growth. It takes more than just focusing on operating cash flows to make the company growth sustainable and financially sound. This financial health is also represented by EBITDA and net income margins. Earnings before interest, tax, depreciation, and amortization is a measure of company's operating performance independently of its financing and accounting decisions or tax environment. On the contrary, net income is the residual amount of earnings after all expenses have been deducted from sales. When we divide each of these metrics by sales turnover, we get the respective respective margins. Investors tend to prefer reviewing operating cash flows over net income because there is less room to manipulate the results. Cash is king. If you want to have a look at an example of how these metrics are presented, take a look at Morningstar, where you can have metrics in depth with a subscription. You can also access financial information easily from Yahoo Finance for both public and private companies. The monitoring of financial health continues in the takeoff stage, and this is a pivotal period in a company's life. If the company overcomes the financial and managerial challenges of this stage, like resource planning and delegation, it can become a big business. For example, the company does not have to engage in a race to the bottom with its rising number of competitors. If not successful, the company can perhaps be sold at a profit, provided the owners recognize their limitations soon enough. The final stage is resource maturity. Here, the company tries to consolidate the financial gains provided by rapid growth, but also its inefficiency incurred for gaining speed. The company fully engages in operational and strategic planning. For this, best financial practices are fully implemented. Tools such as budgets and standard cost systems then become natural. And obviously, the company can always continuously experiment new products that could bring new revenue streams. It is not surprising that in the annual list of the world's top chief executives published recently by HBR, 70% of the score that makes them to be classified among the best performing CEOs in the world is due to financial performance. So consider that the current environment of low interest rates and cheap funding is not going to last forever. To be prepared for more adverse scenarios, we revisited the stages of business growth and highlighted how they interact with key financial performance indicators. It is not about a one-size-fits-all solution. It is about common steps of business growth and how they interact with proper financial practices. These indicators help companies preserve their liquidity and profitability while growing sustainably. Let us know what you think about the current financial environment and your opinions about financially sustainable growth in the comments below. Don't forget to like and subscribe, and see you next time.